We should also have Richard Law, who is an investor and the executive chairman. So Ben, I think it'd be great if you could sort of just kick the call off and introduce yourself. Let us know how you set Vypr up and what it does and how you help its clients.
Yep, sure. Morning, everybody. Morning, Ray. So yeah, I'm Ben Davies. I'm the founder of the business. Set it up about 7.5 years ago now, back in 2013. So prior to that, my career had been in the consumer goods space, which is the sector in which we operate. So I was a buyer at Sainsbury's and the Co-op for probably 6 or 7 years in total, something like that. And then I've worked in food manufacturing management consultancy, helping a number of European food manufacturers build their business in the UK. So yeah, got good knowledge of the consumer goods market, particularly focusing on food and drink. So as I said, set Vypr up in 2013. The reason behind it was a good understanding and experience of the pain point for us, and that is what the pain point around product innovation, NPD as it's called in food and drink. It's the metrics within grocery and within broader consumer goods are really not that strong in terms of the success rate of new products and innovation. In food and drink, in the grocery market, there's about 85% of all new products that are launched on an annual basis are gone within 12 months. So there's a real lack of stickability. And the flip side of that is the cost that it requires for manufacturers and retailers and other channel partners to get to get products to market. It's a very slow process. It lacks really kind of solid consumer data. So I saw an opportunity to really apply technology and data to this pain point, and that was the founding vision of Vypr. I was particularly inspired at the time by crowdsourcing websites. There were a couple of quite big American businesses that were doing quite interesting things in terms of crowdsourcing invention around new products and bringing them to market very quickly. And we've evolved from there over the past 7 years. So, kind of me and a set of PowerPoint slides and an idea and a vision back in 2013, and moving through the different gears of startup to scale up, completing with the funding round back in January. So yeah, that's probably a solid enough introduction from me.
Yeah, definitely. And Richard, good to see you. Do you want to give a brief intro to you and sort of how you find your way to Vypr?
Yeah, I'd be happy to do that. Can I just check everyone can hear me? Is that?
Yeah.
Yeah. Okay. Great. So, I'm an angel investor. I chair a public company, and I get interested in small high tech businesses. And I have two investing methodologies really. One is to get significantly involved with those businesses I really like, invest quite a lot of money, and take an active part in helping the team grow the business. And then I go the portfolio route for a number of others. But the environment that I'm investing in generally is EIS, which is a great environment to invest in. And I was introduced to Ben and the team about 3 years ago by a guy called Richard Young, who many of you will know. And I really, firstly liked Ben and the team. Secondly, recognised that there was a massive pain point here which wasn't being addressed by anyone else, and there was a real opportunity for this tiny business to become a global phenomenon. And so I decided to invest on the kind of the former methodology. So I'm a large shareholder in the business now, and I chair the business, working really closely with the team to help them fulfill their ambitions.
Oh, that's great, thank you. So obviously, Richard, Ben, you set the business up, so about 7.5 years ago. So what have been the key challenges since you set the business up, growing it to where it is today?
How long have we got? It's quite a journey. I mean, I think looking at it from an entrepreneurial kind of founder perspective, I think there's an analogy that I quite like. It's it's like a roller coaster as an entrepreneur, because you have a fairly unique emotional bond with the business that you set up, and certainly as you go through the early gears, kind of years 1 to 4, something like that, you know, the highs are they feel a lot higher, but equally the lows feel a lot lower, and you can get highs and lows within the same hour. So you really kind of roll with the punches on a kind of a softer emotive basis as you're kind of getting the business going through the gears. I'm a sole founder, so I didn't have kind of co-founders to lean on. So I guess it was quite isolating at times, kind of just being the lone voice for trying to change how what is a very, very big, very established industry goes about developing products, and you kind of get all the self-doubt and all these type of things. So it is quite tough, and you have to be really, really quite resilient. So I would certainly flag those from a founder perspective. I mean, going through the phases is really very enjoyable, but it's also, again, very challenging, kind of moving from one-man startup to, kind of scrappier 5 or 6 person startup through to scale up and now kind of really professionalizing and scaling the business very rapidly. And you have to individually kind of change and adapt to that. And you're taking customers on a journey, you're taking the team on a journey. So that has its challenges for sure. The constant need to raise money, because we've been a business that's been raising equity capital for all of our existence, basically. That is pretty relentless. We've done 7 or 8 rounds now, I think, mostly from angel investors, but obviously latterly from institutional investors, and that's very tiring, on top of kind of trying to either run the business or run the functional teams that you're accountable for. It's a very big distraction on time, and just doing that time and time again pretty much every year is tiring. And then without getting into the kind of nuts and bolts of what we do, we've been trying to build a consumer community at the same time as kind of grow our client base and really sell to some very big enterprise customers at the same time as trying to be appealing to SMEs and startups. And these are all kind of interesting challenges to face up, but the challenges are so myriad and so frequent that you just have to be incredibly nimble and resilient to kind of get through them. So that's what I would say, certainly more from a founder's perspective, I would guess, in terms of answering that question.
And then you touched on it there, but you've raised quite a bit of equity over the last few years. What's been the logic really between doing a debt versus equity? Obviously there's an emotional side of giving away a bit of your business, and it's probably weighing that up against the cost of debt, I suppose.
Yeah, and in fairness, we just wouldn't have got any sensible debt solutions for the first probably 4 or 5 years of our existence, really. If we had, they would have prohibited us doing further equity fundraisers, really. So just from a kind of a practical perspective, it just wasn't feasible. And you want to get really high caliber individuals like Richard and some of our early stage investors. You want to get them properly vested in the business as well. So equity just makes massively more sense for early stage businesses. I think debt will play a much bigger role for us going forwards, but certainly historically equity has been the most natural thing for us to do as a business. Yeah,
that makes sense. And then so go on, Richard.
Well, I was going to add to that, actually. I mentioned EIS earlier, and I'm going to give a pitch for EIS here. So effectively, one of the things that will attract me to a business like Vypr is the ability to EIS invest. Because if I invest 100,000, my only risk element of that is 38.5, because I get 30% back from the government on investment if it's qualifying, and then if it does go wrong for any reason, I get to write off the rest against income tax. So it's a 38,500 risk, and then out the other end, if I get $1 million, or if any investor gets $1 million in the current corporate CGT environment, the investor gets 800, but as an EIS investor, he doesn't get any tax. So in actual fact, there's a lot of numbers there, but the multiple return on an EIS investment under that scenario, investing 100 and getting $1 million back, is 26 times. Whereas in a non-EIS qualifying business, it's 8 times. So there's a massive kind of leverage there. So that's from an investor perspective and attracting investors, which has been really helpful to Ben at all stages of the journey. He brought in some of the biggest names in food and beverage in the early rounds. And then in later rounds, other people have come along who have been leaders of significant potential clients. And then also people who can come along, like me, and just bring the experience and knowledge that helps. So yeah, I think for those reasons, equity is a good tool to use at this stage in the game of a business which has got variable profitability, operating in loss for a lot of the time.
And as an investor, Richard, what do you think that you were able to bring to Vypr to help them get to where they are at the minute?
Well, I was going to say you should ask Ben that, but you might want an answer I'd like him to give. Well, the thing is, what I'm really fortunate to have done through my working career is I've been an engineer, and I've worked with RTZ and big engineering companies overseas in Australia. I've been with EY, qualified as a chartered accountant, then worked in corporate finance. I've been a public company finance director. I've been a public company CEO and chair. So in that whole journey, I have like a tool bag of all of the tools I've picked up along the way. It often helps to cut a lot of corners. I'm able to make, to introduce contacts. There isn't much that Vypr will be doing that I haven't done before in some other way. And I've probably screwed it up before, but with Vypr, I can help them get it right. But let me just make this point that any chairman, investor is only going to be able to guide an otherwise really high quality team operating in a really good nascent sector. And Vypr has all of those things. When I first saw Vypr and the pain point it was trying to address, I thought, wow, that is a pain point that is felt by all FMCG businesses right across the world. It's a huge opportunity. Vypr had already got a great product that could address that. It had a good team. What we've done is we've grown out the team, we've advanced the product, we've looked at international territories, and the business has made really, really good progress to doing what was my number one objective. When I came in the business was still very fledgling, about 700,000 of turnover, losing 900,000 at the bottom line. In the last financial year to March 20, it did 1.25 and made about 100 grand. And at that stage, then the whole team in Vypr can genuinely say, we've created something that is ready to scale. It's ready to break out. We can put resource behind this with a high degree of confidence and see it grow quickly and expand.
I think it's not just applicable for FMCG anymore, is it? I mean, you've expanded into lots of different sectors, and it's doing well in those as well.
Yeah, we've extended into financial services. There are applications within government. There are applications within travel and leisure when travel and leisure returns. So across the whole board, this is high quality insights for organizations that need to make high quality decisions to give them competitive advantage. That's what Vypr does very reliably and very accurately.
Okay, so again, you touched on where you got to a turnover for FY20, which is around the number where institutional funders start to get involved, when you get around that £1 million mark. Was that always the plan to get to the £1 million recurring revenue and then go for a fundraise?
Yes, it was really, Ryan, to get to the stage where we all felt comfortable we had something we could scale. So the million is coincidentally where institutional investors get involved, but it could have been bigger, it could have been smaller. It's just getting to that stage that you know that you have something, processes, products, systems, go-to-market, playbooks, all of that kind of stuff, where you know you can turn the wheel. Since we started the funding process, which is only 5 months ago or something, it was very quick and efficient process. We're already up something like 40% on the size we were at the time, and we're beating the forecast, and that's a great place to be. Obviously, the reason for that is because we were ready to scale, and so we're not seeing the inertia of, oh, we thought we got that sorted, but it hasn't. So all stop before we push on. Yeah,
that makes sense. And then Ben, this is probably one for you. Throughout the process, we know you met a lot of different funders. What did you think of the different institutions, and really what was the most important element for you? Obviously, the valuation is a big part in terms of dilution, but the fit of the institution as well. It's obviously something which is quite important.
Yeah, I mean, we met probably 6 or 7 potential funders during the process that Richard described, and I've previously, early years of Vypr, I've done the rounds of some of the kind of the London VC firms, and I think the really nice thing about YFM was it felt like very much a two-way process, that they were as enthusiastic about us and our growth plans and ambitions as we were about them and the fundraise. Some funders, it feels like a kind of a Dragon's Den thing. You sit there and you pitch, and there's not much excitement on their side, and you get a bit of a grilling, and it feels imbalanced. Basically, it was never like that with YFM. It was very much a two-way process where they were selling themselves and what value they could bring and what business we could almost build together, as much as we were selling the team and the ambition in the market to them. So I think that two-way process felt quite important. To me personally, valuation is a driver. I wouldn't say it's the be all and end all. I think it can be an early blocker. Probably it can stop conversations quite early if you get a sense that a fund just doesn't see the same valuation as you see. But that two-way process was really good with YFM, and I hope that will continue.
So same to you, Richard. Obviously, you've done this before. What do you think is the most important part when you're trying to find a partner to grow the business with?
Get a good advisor, Ryan. Seriously though, if someone is contemplating this and hasn't done it before, I think valuations in the kind of the PE investing world. It's very, very difficult to understand. They can be cut in any different way to get to the headline valuation you want. It's all about who takes the risk. So you can have a very high headline valuation, but the way the waterfall works on exit is very complicated. And so what we found really refreshing with YFM is they were really interested in the business. And that was clear from the first meeting. They'd done their homework, and they were very inquisitive and inquiring in a very good way. And what we proposed wasn't a deal that drove the highest headline value. What we proposed was a deal that was really simple for all of our shareholders to understand. I won't kind of go into a lot of detail, but basically all of our shareholders, irrespective of when they came into the business, when the business exits, they will get their money back. And then proceeds are spread evenly amongst all the shareholders on a share-by-share basis, as opposed to any kind of preference. The only thing the preference gets you is order. And effectively, what we were really, really keen to do was to make sure that all of our shareholders, irrespective of when they came in the business, were treated fairly and evenly. We didn't put any ritzy structuring or anything. It's probably one of the simplest PE deals you would ever come across. And YFM were an absolute delight to work with, and we're very pleased to have them on as an investor.
And then I think one of the things which people probably find quite daunting, when they consider this type of thing in terms of fundraising, is just the process in general, because I think it can be quite drawn out. Obviously, in your case, it wasn't, but there is a lot of processes, and people feel as if they're going to take their eye off the business. This is probably to both of you guys, how did you find the process in terms of how did it run, and how were you able to focus on the business as well as obviously all the different questions and making sure you got the money?
I'll go first, Ben, because mine will be quite dry and you'll be very interesting, and you will kind of get to the end on a flourish. So in terms of the deal complexity and what because I've done this before, I know what can happen to a management team. So we tried to ring fence as much as possible the management team. We completed the investment for all intents and purposes in December, although it just for signing off trickled into January. December was our biggest month by far in terms of sales achievement. So I think that's testament to the fact that it didn't distract the business or the team. The deal was done. You can kind of keep me honest on this, Ryan, but I think from heads of terms through to closing the deal in substance was about 9 weeks.
Yeah.
And it was very efficient, and it was very smooth. So I think it can be like that. If there's anyone thinking of going through a process like this, don't be put off by, I'm sure some things can get complicated in other deals. In our case, it didn't, but that was because we had a really good investor, really high quality investor, really high quality advisors. We had expertise in the team who knew what to do, and we had team members of sufficient quality who could juggle but still deliver the numbers. So that's my dry version. So Ben, over to you.
Yeah, I mean, we made all the right decisions in terms of getting the right people involved to drive it forward, but even then it is a very time-consuming process. It's for those of us on the kind of the I guess the kind of the coalface of the business day to day, the due diligence process was quite tough, because it was probably, I don't know, 8 to 10 hours a week on top of the day job and on top of all the other stuff that kind of comes at you. So there's no avoiding the fact it's a tough process, and there are firms that would consider doing this without a corporate finance firm kind of advising, and I think that would have made it extremely difficult, just because of the weight of things that you have to go through. So it was a very, very smooth process, and actually, I think many entrepreneurs or founders or management teams would be kind of nervous about the due diligence process, but actually the amount of positive stuff that's come out of that for us as a business is really strong. We had very thorough management due diligence done. We had obviously all the financials, commercial, technical, and they've all given us insight that maybe we as a team, we don't have kind of the ability to kind of step back and reflect on day to day. So it's actually, there's been a number of recommendations and topics that have been covered in the DD that we can feed into our strategy plans going forward. So it's been a really positive process, but there's no escaping the fact it was a knackering 9 weeks, and most of the exec team were on their knees by come Christmas. Yeah. So I think for businesses kind of contemplating going through this process, did try to make sure that you've got the right resource around you to kind of drive it forward, because there are many tales of businesses that drop the day-to-day trading ball while they're raising money, and that it makes life so much tougher. As Richard said, we did really well on our numbers during the process, and if we hadn't at any point, not saying it would have all collapsed in a heap of smoke, but it can't really help if you start kind of missing forecasts and budgets. So yeah, it was a tough process, but a very, very rewarding one. And I think what Richard did very well was kind of get all of the key the key terms and principles agreed very early in the process, so that there was no chance of kind of stuff coming out of the woodwork maybe 7 or 8 weeks in that was, oh right, we've all of a sudden we've got this big issue that we just haven't addressed up front. We you know, you guys alongside Richard kind of really addressed those early, and that set the process on really solid foundations, I think.
That's good. And it's again, it's something we touched on slightly earlier on, but at the very start of the process, you met 6 or 7 different funders. And how important do you think it is to meet a wide variety? Obviously, a lot of private equity houses have different styles. So, what do you think is the benefit of meeting lots of different funders?
I think, Ryan, that it depends on your definition of lots. I think your advisor will guide you in the right direction of the funds that are going to be operating in your size bracket. And then I think 6 or 7 is the right kind of number, because across that spectrum, you will find people that you like for all kinds of reasons. It can be specific knowledge, or it can be just a real good personality match, or all of those things. So the right number, so that you have an exposure to a good choice is important. But I think that number that you brought to us was about the right one.
And I think from, you can't take my supermarket buying DNA out of me. I think there's a supply and demand thing at play early in the process as well. And back in my Sainsbury's days, if I wanted a really good price for a new range of ready meals, I'd make sure I had at least 2 or 3 suppliers kind of tendering for the business, and you'd make it relatively known on the market as well. And I'm not saying that kind of horse trading takes place, but there are benefits to the business to know that there's a few funds interested in investing with you, rather than just having a one-on-one exclusive process very early on.
Yeah, definitely.
I add to that, Ben, that we were out on the road for at least a year, kind of initiating the capital raising, and we saw all kinds of funds. So we went to see London-based Smedvig, Frog, Northwest-based. We're speaking to YFM and others early on. The really important part of that is, whether you raise money or not, you getting your message out there, and then when you're coming along to a funding, you're showing the progress you've made since you first met people, and that makes it much easier, and it's a low overhead thing for organisations to do. I would recommend that methodology.
Yeah, completely agree. I mean, we had a number of touch points with YFM. I think I actually met them before even Richard joined the business originally. So, just these kind of light touch points as you're heading towards a potential funding event can be 2 or 3 years out, and both sides are just kind of keeping up to speed with progress. The worst thing you can do as a founder or management team is say, oh yeah, we're going to go and do 2 million quid this year, and then next time you meet them and you only did 1.2. I mean, that's there's no sure way to kind of kill enthusiasm. So regular touch points for quite a period of time leading up to the event, but setting realistic expectations.
Yeah. And you did say that one of the most, and I'll probably back you up on this as well, one of the most stressful points of any deal is the DD process. But I think alongside that is negotiating the legals, which is always challenging. I mean, how did you guys find that, and how important do you think it is to make sure you pick the right lawyers to advise you?
Yeah, it's really important to have the right lawyers. It's really important to have the right advisors, right across the piece. So spending time in selecting those advisors is really important. We saw absolutely eye to eye with our legal advisors and our corporate finance advisors, in that what we all said almost simultaneously in the first call we had was, we need to approach this by getting a very, very detailed heads of terms, which then translates almost mechanically into the investment documentation, so that it makes the process very streamlined. I think if I was to pick two things that we were advised on by our lawyers and corporate finance advisors, which really made the deal slick, firstly was the do your detailed heads of terms and think of everything. And that will then flow through to the documentation, so there's fewer things to discuss later. And the second thing is because we had a very dispersed long tail of shareholders, some of whom, because they're some real rock stars, some real rock stars on our share register, are difficult to get hold of. And so we took a decision to get powers of attorney from all of our shareholders. And that made the whole process of completing the deal way simpler than it might otherwise have been. So, look, I mean, I think what you're picking up, Ryan, is this is a great business. The team and our advisors managed to achieve in this process a deal that we're very, very happy with. The testament to the fact that it's working is that we've accelerated our recruitment. We are expanding our international reach and recruiting overseas. And we're beating our funding forecasts in the process. So, yeah.
Yeah, good. And so how have you both found the first month under with private equity investment?
Ben?
Yeah, it's been very busy, all very positive. I guess we're like a newly married couple trying to show the best of each other. There's lots of positivity and energy and enthusiasm. We had a strategy day last Friday, which it involved the guys from YFM and our new non-exec, which was excellent. Really, really good, kind of setting the plans for the business. So yeah, feels very collaborative at the moment, and we're kind of going through that post first institutional fundraise professionalization, I guess is a reasonable way to describe it. So just looking at different ways of reporting and getting metrics and KPIs going that will give a better kind of lens on the business for us and all of our investors. So yeah, lots of good stuff, but January's been really, really busy as well. So
yeah, I would concur with that, Ryan. Obviously, it is early in the day, but YFM have brought some really, really, really high quality people onto the board. Ben referred there to the non-exec who is coming to represent YFM, a guy called Richard Thornton. Richard is industry background. The business he was deputy CEO of until recent weeks is about to float on the Nordic Stock Exchange at a valuation that analysts are kind of tipping at round about £1 billion, 750 to £1 billion. And he's got a phenomenal range of experience that Ben and the team are already benefiting from. So, we're very positive at the moment, and we think that the current economic environment plays actually into our favour. We aim to automate and make all business processes more efficient, no need to be face-to-face, and be agile, reduce development cycles from whatever they are at the moment to a fraction of that, and in doing that, deliver huge economic value to our clients. So it's the short answer to your question is it's been a good few months, and we're very much looking forward to the future.
Yeah. And then,
I think just to build on one of Richard's points, from a kind of a founder's entrepreneurial perspective, one of the things about these institutional fundraisers, and in fairness to kind of the bigger angel backgrounds that we did, is that you bring in individuals like Richard and Richard Thornton, and they've got battle scars basically that are incredibly relevant, and it just means that you kind of shortcut a lot of the pain points that us as a business would go through, and the kind of the mistakes that we would inevitably make. It just means that your learning time is a lot quicker than if you haven't got them. So Richard Thornton's got incredibly relevant battle scars from a sector that sits right alongside us. Richard Law, huge amount of experience in data and intelligence and scaling SaaS businesses. And the more people that you've got of that caliber, the quicker it is that you can go through that process of the key kind of, I think Jeff Bezos describes them as one-way door decisions, with the kind of the no going back decisions. You're shortcutting a lot of potential errors and mistakes and trial and error. So feels really positive and lots of momentum at the moment.
So I think, from that, obviously, the money's key. That's going to help you grow, but really it's the soft skills which the institution can bring as well in terms of advice and professionalization. That's probably as important. Yeah,
I would definitely say that. We've got some really high caliber board now, and that kind of second network that YFM bring through either their portfolio companies or other partners in their business that sit on the boards of other businesses. There's a huge amount of experience and knowledge and contacts and network that we can now tap into, which will be really valuable. Yeah.
Great. No, it sounds like it's going to be a really exciting journey for you guys. And then sort of on the back of that, then what does the next 2 to 3 years for Vypr look like?
It's we raised the investment, but we didn't raise just the investment for our current plans. So, as you know, Ryan, in our financial model, with what we planned at the time of the fundraise, left us a significant amount of cash headroom. We're actively looking at other territories, because the same pain point in the UK is global. We're investing right across the team in terms of sales, because we, each license contract we sign has got a lifetime value of 6 times a license contract, and our customer acquisition cost is pretty minimal. So as long as we can keep replicating that model, then it's going to be very accretive to the value of the business. So we're going to scale as quickly as we manageably can in sales, client success. We're bringing on board people who can help us recruit effectively, because recruiting effectively is really important. We're building out our product and tech teams. So right across the piece, we are already investing, and if we get positive signs from the market, we have the firepower to accelerate that.
Yeah, not much more to add really than what Richard said. It's all about people. So if we as a business can get hiring right first time, and we can get really world-class individuals into the key seats that we need, then it's a case of execution basically. If we begin misfiring on hiring, that's when issues start. So it really does kind of boil down to people, as Richard has said. And people are businesses are just a collection of people kind of going in the same direction with a mission and purpose in mind. So to be a world-class business, you need to be a world-class business at hiring and recruiting and retaining teams. So that's a really big focus for us, because that will just enable all of the commercial scaling that Richard has referred to.
Yeah, that sounds really positive. And I think probably the final point is, after you guys have been through the process and everything, how do you feel Manchester is for a business to be if they're looking for investment?
So I'm speaking here as a Yorkshireman. I came to Manchester 35 years ago, and so I've spent more time in Manchester than I ever have anywhere else in the world. So I think I qualify for the passport. So I think I'm able to to comment as an adopted Mancunian. The city that I came into in the late 80s it was a totally different place to the city today. So in answering that question, I'd like to pay tribute to all of the people that made that possible over the years, and the city council has been phenomenally successful over that time with people like Howard Bernstein, Richard Lees, and others. What it's created is a ecosystem of technology businesses not seen anywhere else in the UK, in my opinion, other than London. It produces a really credible alternative to London to young professionals and, anyone to come and work in an area where you don't worry that if the job you came for disappears for some reason, you have to go back to the south. And because that was always a possibility before, you kept your roots in the south and didn't come north. And I think there has been a fundamental shift over the last few years, and it has been assisted by the proof that remote working can work. So for Manchester as a city, I think it is, no doubt about it, the second city now in terms of its infrastructure and its attractiveness, and it offers lots of things that, like affordable housing and schools and countryside, and it has it has everything, even a lot of water. So I think if I was outside of Manchester looking to set up a business in the UK, it would be Manchester, a tech business.
Yeah, I mean, I would echo what Richard said. I mean, from my perspective, the tech ecosystem, even in my relatively kind of short time as an entrepreneur trying to raise money in Manchester, it's changed in the 7 years since I started Vypr, and it's become a really, really vibrant scene. That there was a genuine shortage of capital for early stage entrepreneurs. As probably recently as 4 or 5 years ago, but it's really, really kicked on. And I would echo what Richard said. I think it's without a doubt, it's the second city in the UK to set up a business and get access to angels and institutional funds and really scale a business. And you don't need, you can set the business up in Manchester, and you can, without a doubt, you can build £1 billion business in Manchester. You don't need to move to up sticks and move to San Francisco or down to London. It can be done here, as evidenced by plenty of businesses that are doing it now. So I think that the ecosystem is incredibly vibrant and really, really supportive for entrepreneurs.
Yeah, I think it's one of the points which probably gets repeated quite a lot, though. I think outside of London, Manchester has the second most private equity institutions outside of London. So in Europe, so it's definitely lots there. Yeah,
and there's a very supportive network of founders to tap into, and lots of events and social stuff going on, mostly pre-COVID, unfortunately, but it's a really a genuine network out there for entrepreneurs to get going. So yeah, nothing but positive things to say about Manchester. Just be nice to go back there at some point. Yeah.
No, that's great. Thanks, guys. I think now we'll probably open the floor to any questions if anybody has any. I'll probably just start off with one quickly, just in case anyone else wants to ask. Richard, Ben, again for you guys. What do you think the current economic climate is going to do for investment? Do you think it's going to improve it, or just make it more difficult for people?
Okay, I'll go first. I think I'm really not bothered. I'm not really not concerned about any business which is making things more efficient, disrupting the status quo, making lives better, etc. And most tech businesses fall into that category. So I'm still looking at investments and looking to make significant significant investments in those businesses that I like. And I know that is rather selectively answering your question, Ryan, because I'm just talking about tech there. I think, though, in terms of investing, there is a term called TINA, which is there is no alternative really to investing in stock, shares, companies, etc. And I think that will help, continue to help investment. The public markets are red hot at the moment. It's all kind of a bit counterintuitive. But I suppose what I always do is take a really long-term view as part of any kind of decision making. And I think the post-COVID world will be a much more positive place than the pre-COVID. And that has got to benefit all sectors in the long run. But my heart does really go out to those people at the moment who are working in sectors which are heavily affected. It's been a really kind of paradoxical experience of people affected really positively from a business perspective and others not. And that's a great shame.
Just so everyone knows, by the way, if you do want to ask a question, if you just put it in the Q&A box at the bottom. We've had a question from Peter Holt. So as the world gets back to normal, do you think you guys will be going back to the office, or is the plan to keep agile working going?
You want to go?
Yeah, I think we will end up kind of squarely in the middle. If you got kind of fully office based on the left and fully remote on the right, in fairness, we've always been a business that kind of sat somewhere in the middle. Our dev team are scattered. If you draw a map of the most awkward places in the UK to live, we've basically done that with our software developers. We've got Lampeter and Aberdeen and Brighton. So we've always been a business that's quite good at remote working. But I think we will increase our Manchester centricity over the coming years. It's always been our base, and we've used WeWork actually for the past 2 or 3 years. It's been a really good solution for us. It's just given us that flexibility, but the ability to come together in the base when needed. So we will pursue a hybrid strategy for sure, but become more and more Manchester centric as we scale. We're now putting proximity to Manchester relatively high on the list of attributes when we're hiring people, certainly senior staff members. So we'll just continue building more and more of a hub in Manchester, but we'll always be very open to and well suited to remote working for the wider team.
Yeah. The only thing